The recent halt on US LNG imports by China and Australia did not occur in a vacuum. It was the culmination of escalating trade tensions, primarily between the US and China. The timeline of events reveals a tit-for-tat exchange of tariffs, culminating in this significant development. It began on February 2, 2025, when the Trump administration imposed an additional 10% tariff on a wide range of Chinese imports. This move, part of Trump's ongoing trade war, was met with swift retaliation from Beijing. Just over a week later, on February 10th, China imposed retaliatory tariffs of its own. These included a 15% tariff on US LNG and, notably, a lower tariff on US crude oil. This difference suggests a strategic move by China to diversify its energy sources while targeting a key US export. As tensions continued to mount, China imposed further levies on nearly all US imports. This occurred on an unspecified recent Friday, further escalating the trade war. The culmination of these actions led to the recent decision by China, followed by Australia, to halt US LNG imports. The immediate impact of the joint halt by China and Australia on US LNG imports has been substantial. Overnight, the US market absorbed a $1.5 billion loss. This figure underscores the significant market share held by these two countries in the US LNG export market. To put this loss into perspective, it's crucial to examine China's previous import volumes. In 2024, China imported 4.16 million metric tons of LNG from the United States. This volume translated to a value of $2.4 billion, highlighting the significant revenue stream that is now at risk. The sudden loss of such a substantial market has sent shockwaves through the US energy sector. Producers are now scrambling to find alternative buyers for their LNG cargoes. This situation highlights the inherent vulnerability of relying too heavily on a small number of export markets. The financial repercussions extend beyond the immediate loss of revenue. The uncertainty surrounding the future of US LNG exports to these key markets is also impacting investor confidence. The situation is still unfolding, and the long-term financial ramifications remain to be seen. The decision by China and Australia to halt US LNG imports is a direct consequence of the deteriorating relationship between the United States and China. While trade tensions have simmered for years, the recent escalation can be traced back to the Trump administration's aggressive trade policies. The imposition of additional tariffs by the US in February was widely perceived as a provocation by Beijing. China's subsequent retaliatory tariffs, targeting US LNG specifically, are a clear indication that Beijing is willing to use its economic leverage to defend its interests. However, the roots of the current crisis run deeper than tariffs. There is a growing sense in Beijing that the United States is actively trying to contain China's rise as a global power. This perception has led to a hardening of stances on both sides, making it increasingly difficult to find common ground. The current situation is a stark reminder of the interconnected nature of the global economy. Actions taken by one nation, particularly a global power like the United States, can have far-reaching and unintended consequences. The halt on US LNG imports is a prime example of this dynamic in action. While the halt on US LNG imports represents a significant development, it's crucial to understand China's broader energy strategy. China is the world's largest energy consumer and has been actively diversifying its sources of natural gas in recent years. Historically, Australia has been China's top LNG supplier. Other significant suppliers include Qatar and Russia, the United States, while a growing player in the global LNG market was only the fourth largest supplier to China in 2024. This diversification strategy is driven by both economic and geopolitical considerations. By securing supplies from multiple sources, China reduces its vulnerability to disruptions in any one market. This approach is particularly relevant given the current geopolitical climate. Furthermore, China has been actively pursuing long-term deals with gas producers in the Middle East and Asia-Pacific region. These deals often come with more favorable terms and strengthen China's ties with key energy producers. The current situation with the United States only serves to accelerate this ongoing shift. China is likely to further reduce its reliance on US LNG in the coming years, regardless of the outcome of the current trade dispute. The halt on US LNG imports by China and Australia has created a unique situation in the global LNG market. With these significant buyers no longer accepting US cargoes, American producers are left with a surplus of natural gas. Adding another layer of complexity, Chinese buyers who had previously signed long-term contracts with US suppliers are now actively reselling those contracts. These contracts are finding eager buyers in Europe and Asia, where demand for LNG remains high. This dynamic has led to a peculiar situation where US LNG, originally destined for China, is now being rerouted to other parts of the world. This highlights the flexibility of the global LNG market and the ability of traders to adapt to changing circumstances. However, this reshuffling of trade flows is not without its challenges. The rerouting of LNG cargoes can lead to higher shipping costs and delays. It also creates uncertainty for both buyers and sellers in the market, as established trade patterns are disrupted. The long-term impact of this shift in LNG traffic remains to be seen. It will depend on various factors, including the duration of the halt, the response of other LNG producers, and the evolution of global demand. The current situation with China and Australia halting US LNG imports is not without precedent. It bears a striking resemblance to a similar halt that occurred during the Trump trade war, which began in 2018. The initial US-China LNG contract, signed between Cheniere Energy and China in February 2018, marked a significant milestone in the US's emergence as a major LNG exporter. However, this burgeoning trade relationship was soon caught in the crossfire of the escalating trade war. As tensions rose, China imposed a 25% tariff on US LNG imports, effectively halting shipments. This halt lasted for approximately 400 days, from late 2018 to April 2020, significantly impacting US LNG exporters. The current situation, while echoing this past event, differs in a crucial aspect: the involvement of Australia. Australia's decision to join China in halting US LNG imports amplifies the impact and signals a broader shift in the global energy landscape. The previous halt during the Trump trade war demonstrated the vulnerability of US LNG exports to geopolitical tensions. The current situation serves as a stark reminder of this vulnerability and underscores the challenges of navigating the complex world of global energy trade. The recent halt on US LNG imports by China and Australia has cast a shadow of uncertainty over the future of the American LNG industry. The US, having emerged as a major player in the global LNG market in recent years, now faces the prospect of losing significant market share. The immediate challenge for US LNG producers is to find alternative buyers for their surplus cargoes. While Europe and other Asian markets present potential opportunities, securing long-term contracts to replace the lost volumes from China and Australia will be crucial for the industry's stability. However, the current situation also presents an opportunity for the US to reassess its LNG export strategy. Relying heavily on a small number of buyers, particularly those with whom the US has a complex geopolitical relationship, carries inherent risks. Diversifying export markets, strengthening relationships with existing allies, and exploring new partnerships should be key priorities for the US LNG industry moving forward. Investing in infrastructure to increase export capacity and reduce reliance on foreign-owned terminals is also crucial. The future of American LNG will depend on the industry's ability to adapt to the changing dynamics of the global energy market. Navigating geopolitical tensions, securing long-term contracts, and diversifying export markets will be essential for sustained success. The halt on US LNG imports by China and Australia could be a harbinger of a more profound shift in the global energy landscape. For decades, the world has relied on a relatively stable and predictable energy order, with established producers and consumers operating within a framework of international rules and norms. However, this order is now under strain. The rise of new energy superpowers such as China and India, coupled with the growing urgency of addressing climate change, is reshaping the global energy map. Traditional energy alliances are being tested and new partnerships are emerging. The current situation highlights the growing importance of energy security in international relations. Countries are increasingly prioritizing access to reliable and affordable energy sources, even if it means forging new alliances or challenging existing ones. The transition to cleaner energy sources further complicates the picture. As the world moves away from fossil fuels, the geopolitical significance of traditional energy resources like oil and gas is likely to diminish. This shift could create new winners and losers in the global energy landscape. The halt on US LNG imports by China and Australia could be a sign of things to come. A more fragmented and unpredictable energy order characterized by shifting alliances, price volatility and geopolitical competition could become the new normal. The decision by China and Australia to halt US LNG imports extends beyond the immediate impact on the energy sector. It has the potential to trigger a ripple effect across the global trade system, exacerbating existing tensions and potentially leading to further protectionist measures. The US, facing significant economic losses, might be tempted to retaliate with further tariffs or trade restrictions on Chinese and Australian goods. Such a move would likely escalate the trade war, harming businesses and consumers on all sides. Moreover, the current situation could embolden other countries to engage in similar protectionist practices. The WTO system, already under strain, could be further weakened if countries increasingly resort to unilateral actions rather than multilateral solutions. The disruption in the global LNG market also has implications for energy prices. With China and Australia seeking alternative suppliers, demand for LNG from other producers such as Qatar and Russia is likely to increase. This surge in demand could drive up prices, impacting consumers and businesses worldwide. The halt on US LNG imports by China and Australia is a stark reminder of the interconnected nature of the global economy. Actions taken in one sector or region can have far-reaching and unintended consequences, impacting trade flows, prices, and geopolitical relationships. The international community must work together to de-escalate trade tensions, strengthen the rules-based trading system, and promote cooperation in addressing global challenges, including energy security and climate change. Failure to do so could lead to a more fragmented, unpredictable, and ultimately less prosperous world.